Hi everyone, this is Dimel Gonzalez of Heartwood Financial Services. Hey, welcome to our latest market update and outlook video. This video is jam-packed with information. You know, there's some months where there's not a lot going on, and then there's some months where everything is going on. This is one of them, so you don't want to miss. You want to watch. The whole thing is slightly longer than normal. If you got to split it up, split it up. But you're going to want to watch till the very end. Thanks for watching, and let's get started. All right, to start the market update, I want to address what happened over the last few weeks where we had the market have a pretty sizable drop in the market, almost what's technically called a correction, where the market goes down 10% from a previous high. It wasn't quite 10%, it was closer to 8, but still it was a pretty significant drop. And what happened? Why did it happen? So let's get into it. All right, so let's take a look at the asset class returns for the month of July. So the month of July was a really interesting month for the market. So you may not have noticed a lot of changes overall, but underneath the water, there's some significant rotations happening. And the big news was we had a negative month-over-month CPI report, which means that the Fed could be starting to cut rates pretty soon. So back in July, there was that anticipation of that happening. So that helped, especially these small companies. You can see here, small cap up almost 11% in 1 month. That's more than the whole year. So it had a phenomenal return. Real estate kind of in the same boat, because when interest rates go down, it really helps the cost of capital of small companies and REITs. Okay, and what didn't do very well was all the stuff that's been doing great so far year to date. Those big, large cap tech stocks and those magnificent 7 stocks that you hear a lot about delivering most of the returns year to date. They were only up overall, the S&P, barely over 1%. So it was actually one of the worst performing asset classes for the month of July. The bond market did well, again, with interest rates starting to drop a little bit. That helped bonds go up a little bit. And commodities actually went down. Again, inflation's going down, so it makes sense that the commodities were going down, especially energy. What was interesting there, though, is that gold actually was up. So when you have interest rates potentially going down, that weakens the dollar, that makes gold go up. So very interesting, because already into a week or two into August, some of this has started to change as well, which we'll get more into in the outlook. So stay tuned. All right, so the biggest reason we had close to a market correction is because the economy appears to be slowing. All right, so I got a few data points to show you how this is starting to happen. The first one is the one I've been talking about a lot, and that is inflation. Inflation has been coming down. And so inflation comes down for a number of different reasons, but one of the main reasons is when the economy starts to slow down. So we're seeing that. We're seeing the PCE report. Remember, that's the Fed's favorite number that they look at for inflation. Actually went up just a tiny bit, 0.1 last month in July, showing a 2 handle at 2.5%. So we're getting pretty close to the Fed's target of 2% already. So this is already starting to show that things are slowing down. And recently we had the CPI report, same story. It shows that inflation only went up a little bit month over month, and we're finally again at a 2 handle with CPI. We haven't seen that for 2 or 3 years now. So it's very good to see that, but again, it's because the economy is slowing down. And then we had the Fed meeting late in July, and they kind of surprised everybody by not only not doing anything. That didn't really surprise people, but it was the way they came across as, we're still waiting for more confirmation that inflation, this and that. And so a lot of the market is thinking that the Fed is actually a little bit behind the curve, and they're too late. And this is traditionally what happens with the Fed. They act too late. They acted too late to raise rates, and now they're probably going to act too late to drop rates. So the market was a little unsettled by that. Then on Friday, a couple weeks ago, which is kind of the climax of when things started to kind of slide here, is we had a jobs report, and the jobs report showed unemployment going up from 4.1 to 4.3%. That was a pretty big jump, one of the bigger jumps that we've seen in quite a while. And the unemployment numbers was still a positive 114,000, but it was the lowest number we've seen in probably a couple of years. And so it's starting to show that maybe even now the labor market is starting to soften a little bit, and that could be an omen of a slowdown again in the economy. But the two big reports that I always look at are the ISM manufacturing and services numbers. And those a couple of weeks ago also came out a little soft, especially the manufacturing number that was in the 40s. Remember, anything under 50 means we're contracting. Over 50, that means we're growing. The manufacturing numbers were well under 50, and the services number, which is actually the more important one, was growing, but barely, just like at 51. So again, we're starting to see some slowdown here, and the market is starting to price that in. And now the rest of the story. You ever heard that on the radio? So there is more to the story than just the economy starting to slow. Now, you may remember Monday morning, about a week ago, it was already in August, so I had to throw this into this video because this is big news. We had a really big dip in the market. The market was actually down about 4% that morning, and we had the VIX, which is the volatility index, had the biggest spike since 2008. Okay, so this was pretty scary stuff. And basically, the accelerant to the market drop here. And what happened was what's called the yen carry trade. Okay, I'll try not to get too wonky on this, but basically what happens is because it's been so cheap to borrow money in Japan, where interest rates are zero for decades. Okay, people have been borrowing money out of Japan. And what have they been doing with it? They try to invest it in something that can make them more money. And it's been working like a charm for decades. What they've been doing is they're basically buying stocks. And mostly, guess what? Stocks here in the U.S., especially tech stocks. And so what happened is over the weekend, the Bank of Japan said, hey, we're going to start raising interest rates. Remember what I said before when we were looking at the asset class returns? When you lower interest rates, it weakens the currency. But when you do the opposite, it strengthens the currency. They wanted to raise interest rates while we're talking about lowering interest rates. So what that's going to do is that's going to make the yen go up a lot versus the dollar. Now, why does that matter? Well, it made the borrowing from the yen so that they can buy stocks here in the U.S. a lot more expensive, which means that they had to go back and pay off some of their loans because they were getting margin calls. Basically, they owed too much money and they had to pay some of it back. And when they did that, they had to sell something. And guess what they sold? Well, all the stuff that's been working, right? They've been selling stocks, and mostly U.S. related tech stocks, which is why you saw such a big movement in the market here over the last week or so, especially in those top names. And so it does look like things are settling down. The yen kind of dropped back down a little bit. The Bank of Japan said, whoa, we're not going to raise rates. There's too much volatility. Maybe we'll do it later. So I don't think this problem has gone away, but it's a good reminder that they probably can't raise their rates as fast, and we probably need to be a little careful about how quickly we reduce our rates because it could create this problem again, something that we'll definitely be keeping an eye on. And of course, a lot of this wouldn't happen if the market wasn't at such a high price per earnings. So remember, the market's been doing pretty good in the last 18 months or so, and it's gotten a little expensive. So anytime even just a little rock or a little pebble gets into the shoe of the market, it throws a hissy fit. And so this is what happens when we're at peak valuations. So again, when the market gets kind of expensive, even these little things can turn into big things. So it's a good time to probably be a little bit more cautious, right? All right, right, everybody, before we get into the outlook, I just wanted to do a quick interruption and do a quick education moment to talk about volatility and how it is normal, okay? And a lot of people don't realize this, and I thought this was a really useful chart. You could see that a 3% dip happens about 7 times a year. 5% dips happen 3 times a year. And a 10% dip, or technically a correction, happens about 1 time a year. So what we witnessed here recently with the market is pretty normal. And so we've been a little spoiled. We haven't seen a lot of volatility except for around the pandemic time. But prior to that, we really hadn't seen a lot of volatility. And so I just want to explain that volatility is pretty normal. This is why the stock market has a much better rate of return over the long term than other things, because it has a lot of volatility. And just for the record, you can see when a bear market, which is 20% correction, happens, it's usually around every 3 to 4 years. And so we did see this right around the COVID pandemic, but prior to that, it was 2008. And so we've been a little spoiled with not having a lot of these bear markets as well. But just wanted you to see this because the volatility we're seeing today is pretty normal. All right, the big question that I want to answer with this market outlook portion of the video is, are we experiencing a growth scare or is it something more? Let's get right into it. All right, so I phrased this question in a very specific way because some people don't think we're even experiencing a slowdown, but I think we are, and I do feel like the growth scare hasn't really ramped up too much yet, but it could still get a little bit worse maybe before it gets better. Okay, shoppers are starting to tighten their belts, and remember, the U.S. economy is 70% consumer driven, so it's very important how shoppers are acting. And so there's a lot of anecdotal evidence out there already. We're seeing companies like McDonald's, we're seeing Airbnb. We just heard yesterday from Home Depot all talk about how they're seeing their consumers become a little bit more choosy. They're starting to buy, a little bit cheaper items, and they're pulling back a little bit. And again, we're starting to see things slow down. And so we're seeing it more on the anecdotal. I think we're going to start to see that soon as well in the actual data, although it still hasn't quite trickled down yet. In fact, just this morning there was a report from Walmart saying everything looks great. So I don't know what you guys are talking about. But what's interesting, again, Walmart is for lower priced items, right? And so maybe what you're seeing is people trading off for the more expensive stuff for the cheaper stuff at Walmart, which is why they're doing a little bit better. So again, that is to me some signs of some chinks in the armor of the economy. And I would also point out consumer confidence is been coming down a little bit ever since COVID. Right after COVID, it went way down, but then it kind of came back up. But then it's been kind of trailing since that initial comeback after COVID. And I'm not saying it's bad, but it's definitely not improving. And so you're seeing, again, some signs of a little weakening in the consumer, which is, again, very important for the economy. So to answer the question, are we experiencing a growth scare or something worse? Well, we're definitely, I think, going to be going through, if we're not already going through some softening, and potentially we're going to see more growth scares occur. So I think here over the next couple months, we're going to see a little bit more volatility, more vulnerability in the marketplace. All right, so not everything is negative. Don't get me wrong. I just wanted to point out why I have some concerns about how the economy could be slowing and there could be some scares. But there are some good signs too. And one of them is during election years, the market tends to do pretty well. Now, what's interesting, and this chart gets into a whole lot of detail, but I want to just emphasize on the right here what happens 3 months before and after the actual elections. This goes back to 1972 and how the market's averaged. And you can see the 3 months prior to an election, the market's still positive, but not up a lot, 1.5%. And then the 3 months after, the market has averaged 5%. And so what that tells me is, again, the market just likes certainty. It likes to know what the rules of the game are, even if the rules are not as favorable as they were before or more favorable than they were before. They just like to know what those rules are. You can see that in the numbers here. And the last thing I'd like to show you here before we talk about the Heartwood implications is essentially earnings still look pretty strong. This is a pretty busy chart here, but basically what I want you to see is when you go from left to right, you're seeing how the earnings kind of went through a little soft spot in 2022 and it's been coming back since 2023. And the projections for 2024, you can see there's a lot of green there. And you can see actually the fourth quarter of 2024 is the most green of all. And in fact, a pretty big green number, 17%. So in other words, analysts are still predicting that the corporations here in the U.S., here in the S&P 500, are going to mostly be growing their earnings faster over the next few quarters than they have been. And so that is a good sign for the market to continue to do well. All right, so I've given you a lot of information here. We talked about all the craziness that happened at the end of July and over the last couple weeks and why that happened, and it seems to be settling down now, but not going away entirely. And then we're also seeing the economy is slowing down. There's some chinks in the armor, but not everything is doomsday. There's still some good signs. The corporations are going to still be making good money and growing their earnings, so that will be great for stocks. But definitely because of the high valuations and some of the chinks that we're starting to see in the armor of the economy, I think it's a good time to be a little bit more cautious. So I am aggressively rebalancing, and what I mean by that is when I see that we're a little high in stocks and a little low in bonds or cash, I'm not waiting around as much as I used to, and I'm doing that trade a little bit more actively, where maybe in the past I would kind of wait and see a little bit more. So I'm being a little bit more aggressive in the rebalancing, but pretty much everything is still the same. I'm keeping a slightly bullish point of view with the models. We're again adding more to the large cap income focused type stocks. I didn't fall for this kind of false, I call it a false rotation where everything was going to small caps. Small caps do well when interest rates go down, and that is definitely in the cards, but they also do well when the economy is actually accelerating and getting out of a trough in the economy. And we're not quite there yet. So I think we still may be a few months away. So the patience here is, I think, really paying off because we've seen a pretty big hit to small caps here recently. And it's back to the old rotation that's been working. And so this is where we are right now. If you guys have any questions, I know we talked about a lot of stuff and there's a lot going on, please feel free to reach out. Please feel free to share this video because you're not getting this kind of information from the news channels and not even the financial news channels. They oftentimes don't get into the particulars like this that really are the things impacting your portfolio. Thanks a lot everybody for watching, and God bless.